Good morning. There are three things I want to talk to you about today. Factoring accounts receivable, credit card transactions, and also accounts receivable turnover. So let me get me out of the way, and you should see an Excel file. First of all, factoring is when a company sells their receivables. You know that accounts receivable is an asset. You can sell accounts receivable just like you can sell any other type of asset, although it might be easier to find a customer, say, for your used vehicle than for your accounts receivable. It takes a special kind of customer for that, and typically this would be some sort of a finance corporation. So there are companies that are in business to help other companies with their cash flow needs. And one way they might do that is by purchasing their accounts receivable. So when you sell your receivables, that's called factoring. The company that purchases the receivables is called the factor. And like I said, it's typically some sort of a financial institution. When you sell the receivables, you might sell them with notification or without notification. And that means, do you tell the customer or not? So if you sell them with notification, that means that when the customer sends in their payment, they will send their payment to the factor now, the one that owns the receivables. And of course, if you don't tell the customers, then they'll just send the payment to you, just like normal. Another possible terms that you might have as part of the factoring transaction is whether or not they are factored with recourse or without recourse. What this means is, does the purchaser have any legal recourse against you, the seller, if the customer doesn't pay? So it has to do with who bears the risk of non-collection. So if you sell the receivables with recourse, that means if the customer ends up not paying, then the factor can come back to you and say, hey, your customer didn't pay, so now you need to pay me back. If you sell the receivables without recourse, that means the factor, the one who purchased the receivables, has no legal recourse against you, and so if the customer doesn't pay, then they take the hit. They, would suffer the loss. So you might ask yourself, okay, so when we're negotiating about the price of the receivables, what's going to impact how much they pay? Well, these terms here would be one. If you sell them without recourse, that means the factor is taking a bigger risk, and so of course they would pay less for those receivables because they may end up not collecting all the money. You might recall we talked about an aging schedule, an aging of accounts receivable. It lays out how old the customer balances are. And so it's a measure of the quality of the receivables, and so that would also be an input to that negotiation about how much they're going to purchase the receivables for. So as an example, suppose we have accounts receivable of $50,000. And we decide, rather than wait for the customers to pay, for whatever reason, we need our money more quickly. So we go to AAA Financial Corporation and talk with them about purchasing these receivables. So how much do you think they would pay for the receivables? Would they pay more than $50,000, $50,000, or less than $50,000? Well, remember that if every customer pays everything they owe, the most that AAA Financial Corporation would collect is $50,000. So the only way they're going to make money on this is if they pay less than $50,000. So maybe we look at an aging schedule and talk about the quality of the receivables, and we negotiate about the with or without notification, without recourse, and we decide that we will sell the receivables to them at a 30% discount. So If you take 30% off of the 50,000, let me see here, that would be a $15,000 discount. So they're going to give us 35,000. So the transaction would be recorded this way. They would give us 35,000. We would give them the receivables. So we're going to take them off our books. So we're going to credit 50,000 to the asset account, accounts receivable. And the difference is factoring expense. That $15,000, you might think of it as a cost of financing. So we would call that factoring expense. Factoring seems kind of like a weird transaction, but actually selling receivables is a fairly, well, selling accounts receivable would be perhaps a transaction of last resort, because it can be fairly expensive. But there are different types of receivables where it's a more typical type of business. For example, when I financed my house, First Financial initiated that mortgage, which to them was a receivable, but they told me at the very beginning they were going to sell that mortgage to another company. So that was done with notification. And so, again, it's a factoring type, not exactly factoring. Factoring is when you sell your customer receivables. But there are similar types of transactions, throughout business. Another similar type of transaction is credit cards. Suppose I go to Walmart and I purchase a $500 TV. So here's my TV, here's me, and I pay with my MasterCard. Okay, so let me get my picture out of the way here. So we have three parties involved with this transaction. Walmart sells me a TV. I pay with my credit card, MasterCard. So I'm going to pay MasterCard when they send me a bill. So, how does MasterCard make their money if I pay the balance off each month and don't pay any interest on it? So, credit cards is kind of a sensitive topic. It can be a matter of convenience, but it's the worst form of financing that you can choose. So, because the interest rates can be so high. But if you pay your balance off every month, then you're not going to pay any interest. So, let me kind of go back into that transaction. If I pay for that $500 TV with my MasterCard, and let's say that there's an agreement between Walmart and MasterCard that the transaction fee is 1%. Now that's not interest on what I purchased. That is simply a transaction fee that MasterCard is charging Walmart. So, a couple of questions here. I get the TV set. How much am I going to send to MasterCard? Well, when I get that statement at the end of the month, I'm going to pay it off in full. And so I'm simply going to pay $500 to MasterCard. I'm not going to have any interest charges because I pay the balance off every month. Now, how much is MasterCard going to pay to Walmart? Well, remember, they have an agreement where there's a 1% transaction fee. And I'm making that up, the percentage there. What that means is that MasterCard will keep that 1%, that $5, as a charge for the convenience of that transaction, and they will send $495 to Walmart. So it's MasterCard that's incurring that transaction fee, not me. So how will Walmart record that transaction? Well, let's assume that TV was on their books for $350. Remember, anytime a retailer sells their inventory, there's two things to record. They have to record the cost of that sale, so they're going to take the inventory off the books and record that as cost of goods sold. And then they would also record the $500 sale. So we would credit $500 to sales. They're only going to get $495 from MasterCard because that transaction fee is kept. And so the $5, let's just call that a credit card expense, or whatever they choose to call it, some sort of a credit card financing expense or something. But again, that's not my expense. That's MasterCard's expense because they agreed on that with MasterCard. I mean, that's Walmart's expense to MasterCard. Okay, I've got one more topic I want to talk about, and that is accounts receivable turnover. Now, you may recall that we talked about inventory turnover back in chapter 4, so you may want to go back and review that. But let's talk about what's called the operating cycle for a business. A company that sells a product, they buy their inventory, and then that inventory sits on the shelf until they sell it. And then if they sell it on account, there's some collection period, some number of days there until they collect from the customer. So from the time they buy the product until they collect from the customer, we call this the operating cycle. And it's a very important window of time for a company to be able to monitor, because they're waiting on their cash for that amount of time. So we talked in chapter 4 about how to measure how long that product is sitting on the shelf with what's called inventory turnover. We took cost of goods sold and divided by the average inventory. And so in this case, I can give you the information up here. Cost of goods sold of $600,000, inventory $115,000. So if we divide the two, that would be 5.2 turns of inventory in the year, and divide that into 365, and our inventory turnover is 70 days. Well, we can do so in other words, the inventory is sitting on the shelf an average of 70 days until we sell it. We can do a similar type thing with accounts receivable. If we take the sales from the income statement, in this case was $750,000, and divide it by the average accounts receivable, 90, that would tell us how many times the receivables turned over during the period. In other words, they were constantly being collected and replaced as sales and collections happen throughout the period. And since these are annual financial statements, those sales came from the income statement for the year. That means that during the year, the receivables turned over 8.3 times. We could divide that into 365, and that's almost 44 days per turn. If we add that together with the inventory turnover, that's a total operating cycle of just about 114 days. So it was 70 days up here for the inventory turnover, and then it was 44 days, we'll say, rounded off, for the accounts receivable turnover. So the total operating cycle, about 114 days. Okay, that wraps up our chapter 5 discussion.